Hey everyone, welcome back to Corporate Decoder, the place where we decode all the boring corporate filings so you don't have to. Today, we're diving into DigitalBridge's annual report, and let me tell you, it's a bit of a digital maze. We're going to make sense of their financial performance and take a look at if this company can keep building its way up, or will it be another overhyped tech stock. DigitalBridge is all in on digital infrastructure. Think of it as the picks and shovels for the internet, data centers, cell towers, and fiber networks. They manage money for big investors like pension funds, and they're betting big on the growth of all things digital. They want to deliver attractive risk-adjusted returns. They're a global company headquartered in Boca Raton, Florida, with 324 employees. So how does DigitalBridge make money? It's all about managing investments. They have different kinds of funds, from value-add digital infrastructure to core equity. They also do credit and even manage liquid securities, stocks and bonds, all within the digital world. SAF, or Strategic Assets Fund, is their core equity fund. Their main strategy is to invest in digital infrastructure assets with what they call durable cash flow, meaning a stable and predictable income stream. They like assets that benefit from trends like artificial intelligence, 5G, and cloud computing. DigitalBridge prides itself on being industry experts that will help them find the best deals, avoid competitive bidding wars, and will give them an advantage in acquiring companies. The company also has balance sheet management, which they are among the first to securitize digital infrastructure assets. Because they manage so many different funds, there's a risk of conflict of interest. So DigitalBridge has a policy to allocate investments fairly and equitably over time, based on factors like investment objectives and available cash. They make money through management fees, like a percentage of the assets they manage, and incentive fees, which are a cut of the profits they make for their investors. If the fund does well, DigitalBridge does well. Carried interest represents a disproportionate allocation of returns of up to 20% to the company. The investment management business is competitive. They face competition from other firms trying to attract investors and acquire companies, including other private equity sponsors, credit and hedge fund sponsors, and REITs who may have greater financial resources. The ability to transact attractive investments will depend on a number of factors, including reputation and track record, capital availability, cost of capital, pricing, and risk tolerance. They face competition from investment managers of private equity, infrastructure, credit and hedge funds, REITs, specialty finance companies, commercial and investment banks, commercial finance and insurance companies, and other financial institutions. A chunk of their revenue, earnings, and cash flow are variable because performance fees from their asset management business can change a lot. If their fund does well, or if an investment of theirs goes through some kind of change in value, it can make a significant impact on their bottom line. The company warns that difficult market and political conditions like inflation and high interest rates could hurt their business. They also depend on their ability to raise capital from investors, and there is no guarantee that can happen. Since DigitalBridge has expanded internationally, they face business risks in Europe, Asia, and Latin America, like currency exchange rates and political instability. Also, there can be no assurance that valuation methods for certain assets are correct. So, the potential misstatement of performance fees is something to keep in mind. DigitalBridge is a large organization, so it has to deal with the risk of running into conflict of interest, and it has conflict of interest rules in place. DigitalBridge also stated that their funds may be forced to dispose of investments at a disadvantageous time. Because, if they can't extend the term of the fund with investor consent, they may be required to seek to sell at a disadvantageous time, which would result in a lower than expected return on investments. Climate change and regulatory and other efforts to reduce climate change could adversely affect their business. In other words, if the digital infrastructure gets harmed by extreme weather, it can be bad news. As a company, they depend on their key personnel, and if they lost a bunch of key employees, it could have a material adverse effect on their business. Like any tech-heavy business, cybersecurity is a big deal. A data breach or system failure could seriously disrupt their operations and harm their reputation. The market price of their stock is very volatile. As a holder of stock, you could lose a significant amount of your investment if the market price drops. As of 2024, the company announced it would pay shareholders $0.01 dividend per share of common stock to be paid in April 2025. Now let's break down the numbers. Fee revenue increased by 25% to $329 million thanks to new capital raised. Distributable earnings was $52.5 million. Some of their profits, though, are allocated to senior management and other employees, so that reduces their earnings. In 2024, the company also reduced its leverage with a full exchange redemption of senior notes. Now here's my take on DigitalBridge. Overall, I'd say I have a slight bullish bias. As an investment manager, competition is fierce and market conditions aren't easy right now, but the company seems to have a good grasp on where they are going. They are taking digital infrastructure seriously, and that appears to be working. One thing I'm watching closely is their debt levels. They have quite a bit of it, which can be risky if things go south. Also, there is always the potential for changes in accounting policies or tax laws that could affect their profitability. This is one of the bigger risks as far as I'm concerned. Still, there could be more opportunities if we can successfully navigate the competitive landscape in which they and their managed companies operate, and they may be able to generate returns for stockholders. The general consensus on Wall Street is that DigitalBridge is trading at around $17 per share, but based on my analysis, a reasonable target price range would be $18-$21, as this stock has a higher value than what the public might think. Thanks for watching. If you enjoyed this video, please like and subscribe for more corporate deep dives.